Okay, so if you really want to succeed in investing, there are two fundamental concepts that you absolutely have to master. Forget all the complex charts and jargon for just a minute. We're going to focus on the two pillars that will support your entire strategy, your time horizon and your tolerance for risk. Let's get right into it. Let's start with this really powerful idea from the legendary investor Howard Marks. He frames those market swings, the ups and downs that scare so many people, not as some kind of mistake in the system, but as an actual feature. Volatility is basically the price of admission you pay for the chance at real long-term growth.
So, this really gets to the heart of the matter, doesn't it? We all want those amazing returns the market can offer, but man, we are terrified of losing our money in a crash. So how do we actually navigate this? How do you get the upside without letting the fear of the downside completely derail your plans?
This conflict, right here, wanting growth but feeling that fear, that's the classic investor's dilemma. And the solution isn't to get rid of the fear, it's to understand two key principles. And we're going to start with your single greatest ally, time.
All right, let's move on to our first core concept. We often think of time as, a constraint, something we're running out of. But in investing, it is your single most powerful advantage. And it all starts with defining your time horizon.
So, what even is a time horizon? Well, it's pretty simple actually. It's just the amount of time you have before you need to pull your invested money out. Are you saving for a vacation next year? A down payment on a house in 5 years? Or is this for retirement in 30 years? The answer to that question changes absolutely everything.
This slide breaks it down perfectly. For those short-term goals, anything less than a year, your number one priority is just keeping your money safe and accessible. For midterm goals, say 1 to 5 years out, you can start to mix in a little bit of moderate risk. But for those long-term goals, 5 years or more, well, that's when you have the runway to aim for higher growth, because you can ride out the market's bumps along the way.
And this right here perfectly illustrates that core relationship. The more time you have, the more risk you can really afford to take. And why is that? It's because time gives your investments the room they need to breathe, to recover from any potential downturns. A long runway means you don't have to panic during a little bit of turbulence.
And that brings us perfectly to our second big concept, risk. If time is the practical side of the equation, risk tolerance, well, that's the psychological side. It's not about avoiding risk altogether, but about understanding your own emotional response to it so you can actually manage it.
To put it simply, risk tolerance is your personal capacity to watch your portfolio's value go up and down without hitting that panic button and selling at the absolute worst possible moment. It's all about self-awareness, really.
So let's demystify the one thing that really tests our risk tolerance, volatility. It sounds scary, but it's just the market's ups and downs. That's it. In fact, smaller dips of 10 or 20% are actually pretty frequent. They happen every couple of years on average. Now, those huge crashes of 40% or more, they're rare for sure, but they are a possibility we have to be prepared for. Knowing this isn't scary, it's empowering. I really want you to burn this idea into your brain. When the market goes down, it is not a fire. It is a sale. It's an opportunity to buy the same great assets you wanted anyway, but at a discount. This single mental shift can literally transform you from a fearful investor into an opportunistic one. Now, I know what you might be thinking. Reframing a crisis as a sale sounds great in theory, but what about reality? And that's a fair question. So let's take a look at what a century of hard data tells us about market crises.
This study looked at 25 major market corrections, and that's defined as a drop of more than 10%, going all the way back to the 1920s. We're talking about a huge sample size here that includes pretty much every major economic and geopolitical crisis you can think of. And the results are, well, they're really powerful. On average, after one of these major corrections, the market was already up 2.8% just 3 months later. After 6 months, it was up 5.4%. And just 2 years later, a stunning 14% higher on average. The data could not be clearer. Markets recover.
So, what this really shows us is that market corrections aren't some signal that the world is ending. They are temporary phases in what has historically been a long-term upward trend. For the investor with a long time horizon, this data is basically an invitation to practice patience and discipline.
Okay, so we've covered time and we've covered risk. Now, let's bring it all together into a clear strategy with just a few key takeaways.
Here it is, nice and simple. First, define your time horizon for each financial goal you have. Second, always remember that a longer horizon allows for more risk. Third, you have to accept that volatility is the price you pay for growth. Fourth, see crises as opportunities, not as threats. And finally, you've got to tailor your risk level to each specific project in your life.
So I'll leave you with this question. Don't just file this information away. I want you to apply it. Think about your goals: buying a car, saving for a down payment, retirement, whatever it is. What is the very first project for which you are now going to sit down and clearly define your time horizon?